Be ready to learn a simplified trading plan. I talked to one of the winners of the free one-on-ones I give away on my videos. You can participate for the next one by liking, subscribing, and commenting #SMS. I recommend you to grab a pen and a notebook. You will probably need it for the upcoming step-by-step explanation. Without further ado, let's begin. Let me share with you a simple trading plan that you can apply. If you look here, we have 5 simple guidelines that will help you take good trades, okay? First of all, we need a higher time frame bias. Basically, we need a guideline, a framework in which we are going to frame our trade. This higher time frame bias is in terms of what is the highest probability move according to market structure and liquidity. For example, let's say that we are on an uptrend, just to give you an example. Price made a higher low and now we are making a higher high. In terms of probabilities, price is more likely going to initiate a retracement rather than just continuing higher. So most of the time when price is at a premium level, it's more likely going to retrace. Based on that, and based on if we have the liquidity story, let's say we have a lower time frame uptrend like this, and at one moment we start building some equal lows here, for example, or trend line, price is building a bullish sentiment in order for less informed traders to get into this market so they can start saying off, initiating the downtrend. So if you mix both of them, the structure, the fact that we are at premium, and the liquidity story, the fact that price is building a bullish sentiment, it all leads to thinking that the highest probable move is to begin a retracement to the downside. Are you following so far?
Yes.
Okay. So how can we get this higher time frame bias? Either by using that systems that I have for trending markets. Just a quick pause. The video I'm talking about, the trending system, is this one right here. With this video, we'll learn exactly how I frame the higher time frame bias based on a 4 questions system. You can also check my playlist with organized teaching if you're new to my channel, and also my playlist with live sessions from my mentorship. Or using Wyckoff if price has changed the character. Basically, if price is in a consolidation, which is not the same as trending. When the market is trending, that means that smart money is accumulating orders, pushing price higher, coming back to a discount level, accumulating more orders, pushing price higher, and that is happening over and over again. Inside of this higher low or this higher high or any of the swing points here, we will probably have accumulations or distributions. And that's when we are talking about Wyckoff. So if price, let's say that is in a big range and is consolidating, then we need to look at this not using the system, the trending system, but rather using Wyckoff. How can we identify if price started a consolidation or not with a change of character? So what is a change of character? Do you know what a change of character is?
You mean, is it break-off structure?
No. If you're enjoying this video, I would really appreciate if you took a moment to like and subscribe. It really helps the channel and it's completely free. Okay. Well, that's one type of change of character, but let me explain you. So let's say that we are on an uptrend, price making high highs, high lows, and at one moment we make a high high, but price retrace around 100%. It could be less than 100%, more than 100%, but it retraces around that number, okay? The waves down are small, 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 and now this one got bigger, and it is similar to the wave up that we have here. This is a change of character, and it means that smart money is selling, okay? They are selling because they want to start accumulating shorts, or they are selling because they took profit from longs. You know that when we are on an uptrend, if smart money is indeed accumulating longs over and over again, at one moment they want to take profit from the longs, and in order to take profits they need to short, and when they short they move the market like this and they change the character. As soon as this change of character happens, you have to split your screen in 2 halves. Stop thinking in terms of uptrend. You will stop looking for higher highs and higher lows, and you will start identifying a Wyckoff distribution or a Wyckoff reaccumulation. Basically something like this or something like this as a reaccumulation to push higher. This is what I mean when we change the character. So as soon as we see this on the market, in order to identify what is the next logical move, we will try to anticipate what is going to happen in terms of Wyckoff. For this example, let's say that we have a buying climax to automatic rally here because we changed the character and this is a preliminary supply. Do you know Wyckoff, by the way, or you don't know anything about Wyckoff?
Yes, I do.
Okay. So in a normal uptrend, if price making higher highs and higher lows, when price gets to a discount level, we anticipate that the most logical move is that price will continue going higher, right? That's our bias. But for a consolidation, the bias is different. When we have a preliminary supply buying climax and automatic rally, basically a change of character, then we can anticipate different scenarios. If price is more likely going to go lower, then it will probably make an uptrust and then go lower, or make an uptrust, another test, uptrust as execution, and then go lower. We have another scenario where price simply breaks and then redistributes and goes lower. The last scenario will be price makes an uptrust, sign of weakness, uptrust as execution, and then breaks lower. So according to Wyckoff, there are many different scenarios. And if you have them on your mind when you're looking at the chart, you will know exactly what to look for. Because let's say the price from here wants to go lower and break this low. Ideally, what we want to see is a lower time frame Wyckoff distribution here and price breaking with high volume. So we know that there is a higher probability that price will break lower below this low. But if price simply has an uptrend, like it's broken and volume is not so high, that means that this low is probably going to hold and price continuing higher. So depending on what we look for, on what is price showing us when it hits certain level, we will anticipate what is going to happen next. So let's say that price, instead of breaking this low, they want to respect it and make another higher high. For example, something like this. How do we know that this is going to happen? Well, when price gets to this level, they will probably have an accumulation and break that range. And that's the way you know this is a confirmation that price will make a higher high, very likely. Okay, so to summarize it, we need a higher time frame bias that could be either with a trending system or using Wyckoff. Okay, now once we have the bias, let's say that we have an uptrend and price is doing something like this, and we anticipate that the target for this uptrend, are equal highs that we have here, and the target isn't met. That means that price didn't get to that level, so we are anticipating that price will likely going to continue going higher. Okay, now assuming that we have this uptrend and we have this condition, then our bias is going to be bullish because we are anticipating that price will continue going higher. Now, price could reach to the target simply by continue pushing higher, just like that, or after a small retracement, or after a bigger retracement, like that, and then pushing higher. We don't know which one is going to happen, but we can anticipate what is the most likely going to happen. And how can we anticipate this? Well, again, using structure and liquidity. Let's say that we have a Wyckoff accumulation like this here, and it got broken. We have a test and then continuation. In this scenario, the last point of support of this Wyckoff accumulation is this one. Price is likely going to touch this level and continuing higher, producing a very small retracement and continuing higher. But it's different if price, instead of having that Wyckoff accumulation, it has a downtrend that got broken and price just making higher highs and higher lows. In this case, this is the main order block, and price likely going to test that order block to mitigate it before pushing higher. So we would anticipate a deeper retracement. A different scenario, the last scenario, where it simply continues going higher, let's say a price has a reaccumulation here at the top, and then it breaks. Then why will price reaccumulate here very near the equal highs? Because they want to continue pushing higher from here without making any type of retracement.
Okay.
So ideally, every time you look at the chart, you want to have an open mind and evaluate every possible scenario. And based on how the structure and the liquidity looks like, you will choose one of them as the most probable one. Assuming we have this uptrend like that, then the most probable scenario, if this is a target for this uptrend, is to retrace here and then continuing higher. Okay. Now that we have this bias, you can see that the second point here is mark the point of interest, the reversal point of interest. That means the main order book. So in this case, we can consider this move down the graph liquidity before breaking higher as the main order block. So we will mark it. And now this is very important. If we are doing this live, we set an alarm for when price gets to this level. So you use this, right click, an alarm on train view, and that's it. You leave the chart and you only come back if the alarm pops up.
Okay.
Because if you stay in the screen and price starts doing something like this, and it takes a long time to get to your level, and you stay in the screen, guess what? You will try to enter a trade. You will force a trade without following the rules because you are getting impatient. So ideally, that's what you want to do, set an alarm. Now, let's say that the alarm pops up and you go to your screen and you see a price is coming to your entry. The next step is check if the bias has changed. If price came back down from here into your point of interest, then the bias didn't change because price didn't hit the target and our bias was to hit the target. So we are still bullish. But what if you come back to the chart and the chart, instead of looking like this, it looks like this? In this case, if we check the bias did change. Why? Because the target for the uptrend, the purpose of these higher highs and higher lows, were the equal highs, and it was met. So that means that now price is likely going to start a reversal. Assuming that didn't happen, now we are at the point of interest, we need to look for a setup, which is basically a confirmation. So far, are you following me?
Yes.
Okay. Now, the confirmation is very important. You can trade without confirmation, but if you do so, your win ratio is going to be lower, okay? And if you want to be a prop-firm trader, ideally your win ratio should be as high as possible because you have to respect the drawdown rules. And the higher the win ratio, the lower the drawdown, okay? So what is the problem with the break or market structure? A simple break as a confirmation. Let's say that we have a lower time frame downtrend now coming to our point of interest, okay? Let's say a price does something like this, and here, from this order block, price breaks the structure. What happens here? What is the problem with this break? First of all, it's not at a discount level at our point of interest. So that's a red flag. Secondly, because of that, price is coming from an unmitigated order block, and they probably are doing this break not because they want to break the structure and push higher, but because they want to mitigate the order block before continue going lower. Let me explain you this because it's very important. When we have an order block that hasn't been mitigated before, sometimes it happens even when it is mitigated. So mitigation means when price touches the level and then continues going higher. Sometimes even when they come back, they give another reaction. Well, that doesn't matter. The important thing is here is for you to understand the logic behind it. Previously, smart money has opened longs from here. If they want to continue pushing lower into a more discounted level, if they hold these longs here, they will be in a drawdown if price goes lower, okay? So ideally, what they want to do is close the longs that they open here in the past before pushing much lower, okay? Now, how can we close a long? Let's say that we have 50 million longs here and we want to close them before pushing lower. In order to close the long, we need to short. And in order for us to short, we need someone to be buying. Because if we short from here, for example, from here to the downside, no one is going to be buying and there is not enough liquidity for us to short. And if we start shorting from here, we are going to short these longs in a loss. Okay. So ideally, we want buyers to get in order for us to short. So where are there buyers interested on longing? Well, on the last lower high, on this high here. You know that above each one of these highs, there are going to be buy stops from buyers. Yes. So they push price higher and they use these buy stops to short. So they can close the longs that they were here. So after they finish that we say distribution, price can continue going lower. So what you can look for as a break or market structure is only a liquidity graph to continue to the downside. Okay. Now, because we cannot see the future, it's impossible for us to anticipate at an early stage if this is going to be only a stop hunt or if it's going to be a real break or market structure to go higher. It's impossible to know. However, again, we know the priorities because we understand the market structure and the liquidity. Let's say that price wants to actually break the structure and push higher. Then when price comes back to this level, so this new order block, there should be an accumulation happening here to continue pushing higher. But most probably, since this is happening at this level, what you will see is a redistribution and then continuation lower, because that's the real, what they actually want to push lower into this order block so they can mitigate it. But in any case, any trade that you take or any bias will be confirmed with the confirmation. So even if we are wrong about thinking that price will do this before pushing higher, even if we are wrong, we can confirm that with a long here. If there is a confirmation at the bottom here of this order block, then we know price is more likely going to push higher. Now, let's talk about confirmations. Now that you understand the mitigation part. You know, there are two types of break-up market structure. You either have a lower low and a break-up market structure, or you have a failed lower low and a break-up market structure. Each one of these, a different Wyckoff accumulation. And it doesn't always do this. Most of the time, it will be a consolidation, difficult to read, and then break higher, okay? So ideally, you want to confirm it from the Wyckoff point of view. So you want to look for an accumulation. There are many different types of Wyckoff accumulations or distributions. Every time we see a change of character, there are three ways on how this can continue if we are looking for an accumulation. The first is that price breaks the structure, then tests, reaccumulates, and then continues going higher. This is one way of looking at Wyckoff. Selling climax, automatic rally with break-up market structure. Now, the other way that this could happen is that we come from a downtrend, the same scenario, price fails to break the structure, and then we have a normal Wyckoff accumulation with all the different types. We either make a spring and break, or we have a spring, secondary test, we have a secondary test, spring and break, or we have, well, I can do all of them. Then we have the secondary test on phase B, fail up transaction, spring and then break. Okay, these are the most common ones, so you get an idea of how this looks like. We are talking only about the graphical pattern, okay, for now. If you have any question, please let me know, okay?
Okay, in the first one, there's the retracement is coming fully to the SC, but in the second one, it's not retracing with it's coming just near to 50% and is leaving, right?
Okay, that's a very good question. So most of the times, when we are talking about a Wyckoff schematic, when that consolidation is broken, when price comes back to test, the most probable move is that we'll test the higher part of the higher boundary of the Wyckoff accumulation. Different is when we have a downtrend that got broken. In that case, you wait for a deeper retracement. And when we are talking about a consolidation, you have to consider all of this range as your order block. So as soon as it touches, it can continue going higher, just like that.
During consolidation, the retracement happens at a higher,
yes.
Premium.
Yes, most of the time we are always talking about probabilities. Okay, sometimes it will test deeper, but most of the time it will test here. We have a secondary test on phase B, a minor sign of strength, spring, and then break-up market structure. Now, I want you to know something that's very important. These are only patterns, and they not always repeat themselves during the time. This can look very different when we look at the real chart, okay? But it's only to give you a guideline of how it could look like. The most important part that you need to understand, that we explain now, is the volume. The volume, I don't teach it on YouTube. I teach it only on the mentorship, but since you won the free one-on-one with me, I will teach you volume, okay? Great. And it's the key. If trading was an equation, let's say that we have the X, and let's say that this is a constant. You know what a constant is?
Which the value doesn't change.
Exactly. The constant is the structure, and the variable is volume. So the structure is always the same. It's easy to identify a structure. You have higher highs, high lows, high lows. But if we look only at structure, there is one point that it will fail because we have a break-up market structure and we cannot anticipate that. We cannot see the future. Okay. So if we decide to long from here, to long from here, to long from here, at one moment it will fail. Okay. That's the structure. And then we have the volume, which will give you a very high probability setup if you know how to read it properly. So thanks to volume, you will know when the structure is going to be broken, or when the structure, when it's only a stop hunt or liquidity graph, and then price will reverse. And I'm going to talk about volume now. But did you understand this for now?
Yes.
So in order to trade Wyckoff, to confirm a trade using Wyckoff, there are two main things that you need to understand. First of all is a graphical pattern, which is the schematic, plus volume. If both of these are working in harmony, then you have a good setup. Now, there is a law on Wyckoff, which is the law of effort versus results. This law is very important, and it means that volume is showing you the effort being done on any given move. Each one of these waves that we see in a Wyckoff schematic should be paired with what is volume telling us in order to tell us a story.